Welcome back, everybody. I hope you've had a solid start to the new year. It's certainly been an interesting one. And one of the main focuses as we move into this week and next week is earnings, of course. Now, earnings are reflected in growth. So I think, we need to ask ourselves what we need to focus on now, because up until now, equity investors have been totally focused on Fed policy shift and expectations, looking for signs that the Fed may be close to pausing hikes. And to be honest, they probably are. And if we look at the price in peak rates, this is where traders are looking for rates to top out just below 5%, 4.9. The Fed actually is thinking it's going to be higher. So this is kind of what the market started to focus on. And we saw a bit of a rally. We saw at the start of 2023 as a pretty positive start for global equities. But if you look at this, the USA 500, the S&P, this is a 4-hour chart, you can see the pretty strong rally from the 3rd of Jan, just as we got started. It's a positive start to the year, but will it hold? And a lot of this rally is based on the idea of peak inflation. Okay, that may be in place, but what is going on with growth? We're hoping for a soft landing. That could help stocks a little bit as well, but will it eventually be seen? The time now is really to start focus on earnings, because with data turning down, as indeed seen again just today with retail sales, we need to focus on growth, because growth actually feeds into earnings. And the earnings are the centerpiece of equity valuations. And slowdowns are not usually good for corporate profits. So can US indices continue their early year gain as Q4 earnings season moves into full swing? And don't forget, we've still got a lot of the big tech names to come out, and some of the big retailers, and also some of the big global barometers, if you like, the bellwethers for the global economy still to come out. So many analysts have been slashing their earnings forecasts. You can see the downgrades on the chart on the right here. It's been quite stark. So we are expecting pretty weak earnings for this Q4 period. And they've certainly outnumbered the upgrades. Earnings expectations are for an earnings recession to start now and ending about the end of the Q3 this year. So that looming earnings recession, again, highlights risks for global equity markets, particularly US, where these earnings are coming out. So are expectations low enough that traders may see some upside? Look, I think realistically, we're going to get some good numbers out from some, but I think there's some shocks in this as well. At the moment, up until today, or early yesterday rather, we saw actually the Wall Street 30 driving equities a little higher. Fortunately, what we're seeing now is quite a steep rollover. And again, today, we've seen Wall Street leading, the other indices lower. Goldman Sachs profits plunged 2/3 as deal making slumped. We saw a couple of the other banks not doing so well. At one stage, JP Morgan was down, but managed to rally. But it seems like we're getting a bit dragged down here again. And it looks like there's more layoffs coming on from the banks and some of the big tech as well. The situation for companies at the moment is costs are still rising. So input costs are rising. This is contracting margins. Margins matter to equity market valuations. Of course they do. So how do you quickly get rid of or try and maintain your margins? You get rid of jobs. But the problem is cost cutting is not rebuilding your business. It's unsustainable. It helps in the short term, but in the long term, growth and the global economy still matters. Consumer spending is declining. We saw again today, retail sales disappointing. So leading CEOs, I think, are going to be potentially more cautious in their forward guidance on earnings coming up. And these are the things that we really need to listen to rather than just look at the earnings headlines. I think we need to see from the coalface exactly what they're expecting to see in the future. And so far, it's not looking great, with a lot of the banks suggesting further weakness. If we listen to what Wall Street's #1 analyst on equities, Mike Wilson, he's suggesting that a recession risk could fuel a stock market decline quite steeply in 2023, possibly even 15 to 20% in a worst case scenario. But this just shows you how much impact earnings can have on global equities. And US equities at the moment also seem to be suffering from some slight geographical rotation away from US markets, which seem overvalued, to European or UK markets that seem undervalued, particularly in dollar terms. So experience does suggest that trading through an economic downturn and earnings recession often requires patience, or possibly even getting short at some point. But these are tough markets to trade. The early year euphoria could be about to sort of disappear, if you like, as we see this shift from what the Fed's going to do to what is going on with growth. So Friday saw JP Morgan, Citigroup, and the banks. There were beats on revenue and profits as high interest rates, volatile trading conditions boosted income. But all lenders seem to put aside an awful lot of money for risks in the future. That is very telling as far as I'm concerned. And also customers and consumers are drawing down savings. This means that we're seeing an increase in credit card use to maintain that level of lifestyle, which is also unsustainable. So we could see further weakness in retail sales. From what I'm seeing on the credit card data, it's slightly concerning that all the money that was given out to consumers through the COVID period has been spent, and there's a reluctance to actually shift the lifestyle. That means the credit card use is going up as interest rates go up. This is not good. But if we look at the USA 500 since the 9th of January, it's had a good run. I do think we're in this situation where all these things could turn over quite quickly. So I'm surprised a little bit to see stocks manage to finish so strong despite the negatives. But, every now and again, the market does focus back on the Fed. Having said that, we had Bullard, who is obviously a hawk, tonight just coming out and saying that he still saw 50 basis points as a possibility for rate hikes. And that, again, saw yields rally a little bit and dollar rally and stocks fall. So the bank forward guidance is evidence of a worsening US economic outlook. The data is beginning to roll over as well. But it's still a little early to tell the impact on stock indices until we get more earnings releases. So this week and next week, vitally important for stock markets. What is concerning in the background is the disappointing data coming out of the US now on the growth side of things, in the real data, the hard data, if you like, not the survey forward-looking data. This is hard factual data. Retail sales were not good today. So I think we need to bear all that in mind. So technology shares have actually sort of had a very bad 2022, but they have actually started pretty strongly at the start of this year. FANG stocks lost 4 trillion in value since the highs. That is not insignificant. And it really does suggest, as you see on the chart here, whether there is a danger that we could revisit the lows. Now, lower yields have helped, but I do think there is some of this geographical rotation going out of high value American stocks like big tech and some of the other ones in the S&P and Wall Street 30 to push into other areas like the EU, emerging markets. China in particular, I think, now it's talking about reopening, is sucking in funds from the global markets. And I think overvalued markets like the US could be suffering at the expense of, say, European stocks, UK stocks, and emerging market stocks, including China. So tech stocks have a pretty bad 2022. I'm not sure we're going to see this fantastic recovery, but I'll be very interested to see what their earnings come out like. So these earnings were going to be very closely scrutinized by traders and investors. We've got Netflix tomorrow, Amazon and Meta on the 1st of Feb. And don't forget, 1st of Feb is also the Fed rate hiking or rate policy meeting. Alphabet and Apple on the 2nd of February. So a lot going on with central banks in the middle, data beginning to turn down, Fed getting nearer a pause, possibly with inflation peaking, but all this data to come from earnings as well. And earnings do matter to equity markets. Bear that in mind. And I think sector by sector, we could see some shocks out there. There's going to be pockets of good news. I think some companies still will show positive growth, but I do fear there is an earnings risk brewing over the next 10 days.